Hi, and welcome to another episode of Your Future, Your Finances. I'm your host, Brian Kuhn. On this show, we interview a variety of industry experts talking about how their world affects you, and if you work in their field, perhaps some tips on excelling in your own career. We also have on a variety of personal finance experts for your own education. One of those today we're speaking with, I'm very pleased to have on the show, Anirban Basu of Sage Policy Group. Thank you for joining us.
Privileged to be here.
Appreciate that. Tell us a little bit about your group, Sage Policy Group.
Founded in 2004, we're 11 people, mostly economists and policy analysts. Most of our clients are developers, energy suppliers. We do some government agency work as well, mostly at the state and local government level. Clients in more than 40 states, 6 countries.
Fantastic. And the big topic within economics, perhaps, the election result. So some examples of economic implications of that?
So many. Interest rates, infrastructure, defense spending. You know, we analyze from the perspective of the Baltimore, Washington area. We are the swamp. So one of the big questions is, what does this mean for federal agency staffing, whether it's the Department of Energy or the Interior Department or Housing and Urban Development? One presumes that this is positive for staffing levels at Homeland Security and Department of Defense, but it's not clear. So there's a lot of uncertainty affecting the global economy, of course, because some of the policies that have been proposed dealing with immigration and trade affect the global economy. Obviously, the national economy is implicated, but so too, especially, is the Washington-Baltimore metropolitan area.
Yeah. And then there's interest rates. Where do we see interest rates headed?
And I'm not sure that it makes a difference what the election results were on November 8th with respect to interest rates. We thought that they were going to head higher in 2017. That forecast hasn't changed. What has changed is that the expectation now is that they'll head higher faster. And this is because of proposed tax cuts, infrastructure-led stimulus package, other measures that would accelerate economic growth in 2017. We already are approaching full employment. As of this interview, the unemployment rate in the country is still well below 5%, and so 4.7%. And so we're approaching full employment. We've seen average hourly earnings rise 2.9% over the past 12 months. That's the fastest pace since mid-2009. So given stimulus in the midst of a near full employment economy, one would expect more inflationary pressures and therefore interest rates to head higher faster.
Yeah. All right, so interest rates rising. So the Federal Reserve comes out at some point, like they just did, and raises rates. For anybody watching who may not know, what does that actually mean they do and require of the economy?
Well, that means that there is less growth and liquidity in the banking system. And so the rates that they control are the Fed funds rate and the discount rate. These are really short-term rates, but they don't really pertain to you and me very much, at least not directly. We don't transact at those rates. We transact at rates, for instance, the 72-month auto loan or the 30-year fixed-rate mortgage or the 7-year ARM. That's what matters to us. And while there's a lot of attention given to the Federal Reserve and its policymaking, the fact of the matter is these longer-term interest rates at which you and I transact are really what matters, and they have a life independent of the Federal Reserve. In other words, rates can rise much faster than the Federal Reserve is pushing short-term rates higher, or they might not rise at all. And that's what makes a market, that uncertainty, or that's part of what makes a market. My very strong sense is that this is a year in which those long-term rates, the ones at which we transact, will actually increase in meaningful ways.
Really? So why is there so much attention on the Federal Reserve then if it doesn't affect the people operating in the economy?
It does, but really it affects them for a number of reasons. One, the Fed funds rate can affect, let's say, the 10-year Treasury rate and other interest rates. So that's one. But the second thing is there's a signaling mechanism. The Federal Reserve, it's a group of economists, telling you what they think is going to happen in the economy. So when they raise rates, they're telling you the economy is probably going to be pretty good and we can afford to raise rates because we're worried about inflationary pressures. When they're reducing rates, they're saying the economy is pretty weak and it might get weaker, and so we think we need to reduce rates to stimulate economic activity. And that signaling mechanism is really very important, and markets respond to that as much as anything else.
And that's really what they do. They signal the economy, and the economy responds to that.
Yeah, they have oversight over the financial industry.
That, I guess.
Yeah, they have a lot of responsibilities. But, you know, there are many times when we pay very close attention to the Federal Reserve meetings, the open market committee meetings, but they don't raise or lower interest rates. Why do we pay attention when they don't do anything? Because they're telling us what they think is going to happen in the economy, and that really matters.
Absolutely. So overall perspective or outlook on the 2017 year from you?
I think it'll be a good year for job growth. We added not quite 2.2 million jobs as a country last year. State of Maryland added a bit more than 30,000 jobs. Washington Metro added around 70,000 jobs over the past year. So the labor market has been strong. There are various surveys available, including the JOLTS survey, the Job Opportunities and Labor Turnover Survey, produced by the Bureau of Labor Statistics. It indicates that we have roughly a record level of job openings right now. A lot of difficulty filling jobs right now. Construction firms will tell you we can't find carpenters and electricians. Trucking firm owners will tell you we can't find truck drivers, and so on and so forth. So I would expect to see a fair amount of job creation this year. The unemployment rate continues to be quite low. Wage pressures continue to build, and that stimulates overall inflation and higher interest rates.
All right, so let's talk about that. So the unemployment rate is low, and there's a lot of job openings, and then all of the talk is we're going to create even more jobs. So if won't that be more jobs that go unfilled then, or do they mean they're going to train people for the open jobs, or do they not know what they mean?
A couple of questions there. First, we have every year high school graduates and college graduates, so we have some level of growth in the adult working population. So that's one, and they'll fill some of these jobs. But my guess is that the number of jobs that go unfilled will continue to rise. And one of the big questions is that the labor force participation rate in our country has been generally falling. A lot of folks focus upon low participation by males, but in fact the female labor force participation rate peaked in 1999. And so one of the reasons that people don't believe economists when we quote the national unemployment rate or other labor market statistics is say, well, you're not including discouraged workers or people who are working part-time even though they want a full-time job. And one of the questions is, are all those millions of people who disappeared from the labor market going to come back?
Yeah.
And there's some research out there suggesting they're not. They're out. They're maybe permanently retired, on disability, whatever it happens to be. And so at the end of the day, there's not that many workers to fill these jobs. Many of them are not trained. We Americans don't move the way we used to. If you can't find a job in Flint, move to Oklahoma City, move to Dallas. But people don't, they just hang out in their communities year after year. And so a lot of these jobs go unfilled, and that'll be the story this year too.
All right, we're going to pick up with that when we get back. We have to take a break.